Hello, Heart of Economy family, welcome. Today, together, we will explore through the lens of one of the most trusted names in macroeconomics, David Rosenberg, the risk of recession in the United States, the signaling power of real interest rates, cracks emerging in the housing and labor markets, shifts in consumer behavior, and the potential chain reactions across financial markets with full context. This video is not investment advice. Please consider your personal circumstances when making financial decisions. Our goal is to help you read global markets accurately with clear, objective, speculation-free analysis and to strengthen your financial literacy. If you're ready, let's begin. What is a recession and why does it matter? A recession is technically defined as 2 consecutive quarters of economic contraction. But in practice, a recession means rise in unemployment, decline in consumer confidence, companies' health and investment, credit flows tightening, people starting to cut back on spending. In a consumption-driven economy like the United States, a recession affects not just domestic demand, but also global supply chains and commodity markets. This is why it's critical for investors to read recession signals correctly, both for portfolio management and risk hedging strategies. Who is David Rosenberg and what has he said? David Rosenberg is the founder and chief economist of Canada-based Rosenberg Research. He served for many years as chief economist at Merrill Lynch and became well known for accurately predicting the 2008 financial crisis. His analysis is regularly featured on global platforms like CNBC, Bloomberg, and Financial Times, and he is closely followed by hedge funds and major investors, particularly on bond markets, recession signals, and consumer behavior. Rosenberg's approach is this: he does not just look at headline data. He looks at the direction of data, credit flows, subtle shifts in the housing sector, changes in consumer behavior, and psychological thresholds. Recently, Rosenberg made this clear statement: "They call it the boy who cried wolf, but remember, in the end, the wolf actually comes." In other words, recession warnings are not empty fear, and while the data quietly signals recession, many investors fail to notice it. This section is a layered and depth analysis. David Rosenberg's recession expectation is based on 5 key pillars. 1. Real interest rates at critical levels. Real interest rates in the US, meaning inflation-adjusted yields, are currently around 2%. Historically, when real rates have reached or approached this level, in 1987, 2000, 2007, and 2019, the US economy has moved toward recession. Why? High real interest rates increase borrowing costs. Companies avoid making new investments and prefer to hold cash. Households focus on paying off credit card and loan debts, cutting spending. Credit expansion grinds to a halt. According to Rosenberg, even maintaining real rates at this level alone is enough to trigger economic slowdown. Real rates determine the economic's breathing capacity, and when they remain high, they create a suffocating effect. 2. Unemployment rates turning up from lows. Headline unemployment figures may remain low, but Rosenberg focuses on the trend. Historically, recessions emerge when unemployment begins to rise from its lowest point. In the US, the unemployment rate has started to tick up slightly from its lows, Even the small movement is a critical signal because companies' appetite for hiring weakens, consumer confidence breaks, leading to deferred spending. As layoffs increase, a chain reaction of declining demand begins. Rosenberg's approach here is clear. A recession starts not when unemployment peaks, but when it starts creeping up from the bottom. 3. A quiet cooling in the housing market. Housing is one of the locomotive sectors of the U.S. economy. The construction sector accounts for a large share of employment. Real estate and related sectors, furniture, appliances, materials, are directly impacted. Rising mortgage rates slow down demand. Rosenberg notes that mortgage rates staying at 7% to 7.5% have quietly killed housing demand. New housing starts have declined, and this chain reaction is slowing the broader economy. The cooling of the housing market increases economic fragility and heightens the risk of recession. 4. Eroding consumer spending buffers. During the pandemic, government support increased consumer savings, but this buffer has now eroded. Due to rising inflation and high interest rates, consumers have started cutting back on spending, pushed credit card debt to record levels, delayed luxury and non-essential purchases. The U.S. economy is consumption-driven. Consumer spending makes up about 70% of GDP. A slowdown in the spending is one of the strongest signals that can trigger a recession. Rosenberg states clearly, the slowdown in consumer spending is the clearest harbinger of a recession. 5. The pressure created by the Fed's high rate tightening. The Fed is keeping rates high to rein in inflation. Rosenberg emphasizes that this tight monetary policy creates the following risks: borrowing costs rise, companies delay investments, consumers avoid borrowing, credit expansion stalls. If the Fed cuts rates, it will not be to rescue the economy, but to limit the damage of an already underway recession. Rate cuts by the Fed are not to prevent a recession, but to mitigate the damage of a recession that has already begun. Rosenberg. A recession expectation supported by historical cycles. Rosenberg cites periods like 1987, 2000, 2007, and 2020, arguing that today's data quietly signals recession. Real rates rising to critical levels, a slowdown in the housing sector, unemployment ticking up from lows, a slowdown in consumer spending, a halt in credit expansion. These factors may appear minor individually, but combined, they create a chain reaction that pushes the economy into recession. David Rosenberg's clear message is this: they call it the boy who cried wolf, but in the end, the wolf actually comes. Today, real rate levels, the housing market, movements in unemployment, credit tightening, and slowing consumer spending show that the U.S. economy is on recession path. Rosenberg points out that while many in the market ignore these signals, the data quietly indicates that a recession is approaching. Summary: real rates are near critical levels, historically a recession signal. Unemployment has started to turn up from its lows. The housing market is cooling. Credit flows are tightening. Consumer spending weakens. The Fed's high-rate policy is accelerating to slow down. Heart of Economic Commentary. David Rosenberg's analysis shows the critical importance of reading data not just as number, but in terms of direction. The risk of recession is on the table, and we believe investors should not underestimate this risk. Flexibility and cash flow control will be the most important factors during this period. While you may not want to miss short-term opportunities with high bond yields, caution is necessary in long-term positions given the high probability of a recession. Safe havens like gold and silver may offer opportunities in the medium term if the dollar weakens in a controlled manner. However, investing in these assets requires accepting volatility and the potential for sharp price corrections. Short-term release in equities may look attractive, but remember that risks increase in release not supported by data. Investors should avoid emotional moves and focus on macro data trends, not just price movements when positioning. In the bond market, if a recession occurs, bonds could appreciate and provide double-digit returns. If it doesn't, high rates could keep prices under pressure. For this reason, it would be wise to maintain a balanced bond allocation in portfolios. From a global perspective, a potential recession in the US will affect not only the American economy, but also emerging markets, commodity supply chains, and global trade. Investors should avoid the mistake of thinking US data won't affect us. Remember, markets move quickly, but data comes with a lag. Rosenberg's approach reminds us, signals form quietly before they make the headlines. Even if the markets are currently euphoric, risk management should not be neglected, and the possibility of recession should remain in focus. In summary, aim for medium to long-term balance and flexibility over short-term euphoria in your portfolios. Plan your cash flow and risk allocation carefully. Monitor gold, silver, and bonds closely. Analyze whether equity release are supported by data. A recession may not come, but if it does, the prepared investor will get through it with the least loss and capture opportunities. Today we examined in detail David Rosenberg's analysis of recession risks in the US, the signaling power of real rates, cracks in the housing and the labor markets, potential opportunities in the bond market, and potential chain reactions. Rosenberg's message is clear. The wolf eventually comes, and today's signals shows the economy is slowing. For more content like this, don't forget to like the video, subscribe to our channel, and turn on notifications. See you in the next analysis on Heart of Economy. Thank you.